If you think the Federal Reserve just made life easier, you are standing on a bridge that has already started cracking. That is the first thing I want you to understand. Most people heard the latest shift from the Fed and translated it into comfort. Lower pressure, easier money relief, a little less pain for markets, a little more air for stocks, a little more time for the people who built their entire lives, on the assumption that the central bank will always come running with another cushion. I heard something very different. I heard stress inside the structure. I heard a government choking on debt. I heard a bond market that is no longer willing to play along politely. I heard a central bank making the easy move because the hard move has become politically unbearable. And whenever I hear that combination, I stop asking whether the next quarter will look better, and I start asking a harder question. How much longer can the bridge hold? That bridge is trust, not trust as a slogan. Trust as architecture. Trust that the Fed is still independent enough to choose economic reality over political convenience. Trust that the Treasury market is still strong enough to absorb an avalanche of new debt without demanding a much higher price. Trust that the dollar's reserve status is still backed by discipline instead of habit. Trust that the giant stock indexes people hide inside still deserve the valuations they carry. Trust that when the next real stress wave hits, the old rescue playbook will still work. That is the bridge. And if you do not understand that your portfolio is sitting on top of it, you are not investing. You are hitchhiking over a canyon and hoping the engineers you have never met still know what they are doing. The source document you gave me is valuable because it does not treat the Fed's latest move like a technical footnote. It treats it as a warning that policy is bending toward political necessity, while the debt load, the bond market, and the reserve currency structure all strain underneath it. It frames the Volcker era as the last time the institution chose credibility over comfort. And it contrasts that with the post-negative 2008 world of zero rates, quantitative easing, moral hazard, giant deficits, rising interest expense, stubborn long-term yields, and a market still priced as if the old Tina world never ended. That is the real bone structure of the piece, and that is the bone structure I am keeping. Now let me show you the cracks. The first crack is what I call the Volcker standard. I began my career in a world where central banking still had the courage to be hated. That matters more than most people realize. Paul Volcker did not become legendary because he was eloquent. He became legendary because he was willing to let the public feel pain in order to restore something that cannot be faked, which is institutional credibility. He looked at inflation, looked at the political fury that would follow, and decided that the value of a trusted currency and a serious central bank was worth more than temporary applause. That is the Volcker standard. It is not about one man. It is about a principle. A real central bank is willing to defend credibility even when credibility is expensive. The source document opens there for a reason. It contrasts that period with the present because the present is built on the opposite assumption. That pain must always be softened, that leverage must always be rescued, that every cycle can be deferred, stretched, blurred, and anesthetized until the public mistakes postponement for mastery. The source says Volcker crushed inflation with rates over 20% and bought the country 20 years of economic credibility. Then it says the modern Fed spent 15 years doing the opposite, teaching the system that risk is negotiable and rescue is normal. That is not just a policy difference. That is a moral difference in how the institution understands its own job. And once an institution stops seeing its own credibility as sacred, markets start noticing before the public does. That is when the first crack appears. The second crack is what I call the deferral engine. This is the machine that kept everybody happy for just long enough to make the future worse. After 2008, the system should have been forced to relearn respect for leverage, respect for bad debt, respect for valuation, respect for the fact that a cycle must clear. Instead, the medicine became the lifestyle, zero rates, quantitative easing, extraordinary accommodation, then more of it, then pandemic era money creation so aggressive that it made the earlier rounds look almost disciplined by comparison. The source document is very direct about this. It says we move from cleansing to deferral, from reset to suppression, from letting losses clear to teaching the whole system that the Fed would always stand behind risk, taking if the consequences got unpleasant enough. It argues that For a while, this looked genius because asset prices rose, unemployment fell, and everybody who owned anything that benefited from easy money got to feel like a strategist instead of a passenger. That is exactly how the deferral engine works. It rewards people before it exposes them. I have seen this pattern too many times to be impressed by the middle of it. Deferral is seductive because it makes tomorrow feel optional. Borrow today, refinance later, pay too much for an asset today because lower rates will justify it later. Let the government run larger deficits today because growth or inflation or some new technical fix will make the debt look manageable later. Tell yourself the central bank can always blink later, so there is no need to demand discipline today. That is not prosperity. That is leverage putting on a tuxedo. The deferral engine does not solve the cycle. It moves the bill from one hand to another and then acts offended when the waiter comes back. The third crack is what I call the debt spiral. This is where the story stops being ideological and becomes arithmetic. The source makes the numbers impossible to ignore. Roughly $2 trillion annual deficits. Interest expense already above $1 trillion a year. Total federal debt so large that the interest on the debt is now competing with the biggest line items in the federal budget. The source says we are paying more in interest than on defense and more than Medicare. Whether each number moves a little quarter by quarter is not the point. The point is the direction. The direction is the argument. Debt at this scale changes everything because it makes policy hostage to rollover. A small borrower can endure high rates and call it discipline. A giant borrower with compounding interest and constant refinancing needs starts calling surrender by softer names. And that is what most investors still do not understand. They keep looking at the short-term rate decision as if the Fed is choosing among neutral options. It is not. It is negotiating with a debt stock that gets more expensive every time discipline lasts too long. The source calls this a debt spiral and says the options for getting out are limited and all of them are painful. That is the correct frame. A spiral is not a crisis because one thing is large. It is a crisis because each turn of the wheel worsens the next turn. Higher debt means higher interest costs. Higher interest costs means bigger deficits. Bigger deficits mean more debt issuance. More debt issuance means more pressure on the market that has to absorb it. If the market demands higher yields to absorb it, then the interest cost gets worse again. That is not a metaphor. That is arithmetic chewing through a political system that still wants to behave as if numbers are flexible, but confidence is automatic. Confidence is not automatic. Confidence is rented. And when you rent it too aggressively, the landlord eventually raises the price. The fourth crack is what I call the long end revolt. This is where sophisticated money stops being polite. The source says something many retail investors never bother to understand. The bond market is where the serious signal lives. Stocks are glamorous. Bonds are diagnostic. When long-duration treasuries stay under pressure, when the 10-year and the 30-year refuse to fall the way the old playbook says they should when the Fed softens, that is not noise. That is the market refusing a story. In the old world, easier policy at the short end helped pull the whole curve into line. In the stressed world the source is describing, the long end stays stubborn because the buyers at the far horizon are no longer satisfied with slogans. If you are lending to a government that is running massive peacetime deficits with a central bank that appears more politically constrained and a reserve structure that is no longer taken for granted, you do not ask for comfort, you ask for yield. More of it, that is the revolt. Not people shouting in the street, people with trillions saying quietly and expensively, I need to be paid more to trust this. The source frames this beautifully. It says the long end is staying elevated in a way that does not fit the traditional easing narrative. And that what this tells you is that sovereign wealth funds, pension funds, foreign official buyers, the real large pools of capital are not buying the easy story. They are asking to be compensated for risk that used to be dismissed as theoretical. This is one of the reasons I have never let market commentary replace market structure in my thinking. Commentary tells you what should happen. Structure tells you what buyers are demanding anyway. And when the long end starts saying no, your portfolio should listen even if television does not. The fifth crack is what I call the Tina hangover for years. Investors lived in a world where there was no alternative. That is what Tina meant. Rates were pinned. Cash was dead. Bonds were sterile. So money went into equities, not always because equities were cheap, but because everything else had been made useless. That environment did not merely raise prices. It changed habits. It trained people to pay any multiple for growth, to accept concentration in a handful of giant tech names, to treat market cap-weighted index funds as if they were diversification, when in reality they were becoming increasingly concentrated bets on the same kind of business, the same kind of duration, the same kind of liquidity regime. The source document nails this. It says valuations across large cap growth and technology names are only defensible under a very specific fantasy. That rates come down significantly and stay down. That earnings continue to grow in an almost frictionless environment. And that the extraordinary liquidity conditions of the last decade somehow return without the inflationary and fiscal side effects that broke them in the first place. That is the hangover. The party is over, but the portfolio is still dressed for it. Now there is an alternative. Cash yields real money, short treasuries pay, longer bonds demand respect, and yet huge parts of the market are still priced as if Tina never died. A great business can be a terrible investment at the wrong price. That is not a slogan. That is one of the oldest truths in capital allocation. And when you own an index that has become heavily concentrated in a few expensive giants, you are not buying comfort, you are buying valuation risk wrapped in familiarity. Familiarity is not safety. The sixth crack is what I call the reserve drift. This one moves slowly enough that complacent people mistake it for nothing. The source is careful here, and I want to be careful too. This is not a hysterical claim that America collapses tomorrow and the dollar vanishes by breakfast. It is more subtle and more serious than that. The privilege of issuing the world's reserve currency is not permanent. It is a disciplined franchise. The deeper your capital markets, the stronger your legal system, the more trusted your institutions, the more neutral your reserve asset appears. The easier it is for the world to hold your paper and call it safety. But if you start freezing reserves, weaponizing settlement, running giant deficits, and letting monetary policy bend toward political need, other nations learn not publicly at first, quietly, slowly, deliberately. The source says countries like China, India, the Gulf states, and Brazil are not on the fringe of this process. They are large economies making practical choices to reduce dependence on the dollar system, not because they think America disappears, but because they no longer treat dollar dependence as costless neutrality. That is reserve drift. Drift is dangerous because it is easy to dismiss until suddenly it isn't. People are always looking for dramatic turning points because they want a date they can remember. Real systems rarely give you that. They give you accumulation, small decisions, repeated over years, that eventually create a world nobody thought was possible because nobody respected how gradual it was. The reserve drift matters for gold too. And the source says so directly. Gold is not a conspiracy asset in this framework. It is the logical reserve alternative if you are less sure that every pillar of dollar trust will remain unshaken forever. Gold cannot be printed. It cannot be sanctioned, the same way a ledger entry can. It exists outside the institutional promises that paper systems depend on. In a world of growing reserve anxiety, that matters more, not less. The seventh crack is what I call the correlation betrayal. This is where ordinary portfolio theory gets embarrassed. In normal times, people feel diversified because their spreadsheet says they are. A little equity here, a little fixed income there, a little real estate, maybe some thematic exposure, maybe a retirement account they have not opened in 3 months and therefore believe is magically safer. Then a real stress cycle arrives and the correlations they thought would protect them start moving together. The source warns about exactly this. It says you have to stress test your risk not against normal conditions, but against a world of sustained elevated rates. Confidence stress in U.S. fiscal policy, equity correction risk, and a weaker dollar than most people model. That is a grown-up way to think. Diversification that works only in normal times is not diversification. It is decoration. When systems are strained, liquidity does not care about your labels. It cares about what can be sold. And if you have built your portfolio on assumptions that only hold while central bank confidence is unquestioned, and rates are benign, then your diversification is likely to fail precisely when you need it most. That is correlation betrayal. The things you thought were separate start confessing that they were cousins all along. Now I want to talk about the identity flip, because this is where the story stops being an interesting macro essay and becomes a decision about who you are. Most investors still think like index passengers. That is the old identity. They want exposure. They want convenience. They want plausible deniability. They want to be able to say, if something goes wrong, at least I owned what everyone else owned and trusted what everyone else trusted. That identity is comfortable. It is also fragile. In the world the source is describing, and I believe it is describing something real. You need to become a balance sheet owner. That means you think first about what your capital is actually sitting on. What does this asset require to work? What policy path has to remain alive for this valuation to hold? What currency assumptions are hidden inside this so-called safe holding? What debt arithmetic is embedded under this return stream? What concentration have I accepted without admitting it? A passenger asks whether the ride feels smooth. An owner asks whether the bridge is overloaded. That is the flip passenger to owner, spectator to allocator, index habit to balance, sheet judgment. Until you make that shift, you will keep treating every sell-off, every policy move, every rate change as a mood swing instead of a structural clue. Now let me give you the protocol, because fear without protocol is just entertainment. The first thing I would do in a world like this is audit concentration honestly. The source points out something many people do not want to hear. If you own an S&P 500 fund, you may think you own America. In reality, you own a large and growing concentration in a handful of mega-cap technology companies at valuation levels that only make sense if the old TINA world can be revived. Those are not the same thing. So I would open the hood. I would ask what percentage of my so-called diversified portfolio is really one long duration rate sensitive policy dependent bet wearing different logos. That number is usually higher than people think. The second thing I would do is rebuild optionality. The source is excellent here. It says cash is not just a yield vehicle. It is optionality in inflationary times. People sneer at cash because they can calculate its decay in purchasing power. What they rarely calculate is the value of being able to act while others cannot. Some of the greatest investments of my life came not because I was smarter than the room, but because I had capital when the room was desperate. Optionality looks boring in a raging market. It looks brilliant in a real dislocation. The third thing I would do is own some things that do not require perfect trust in paper promises. That does not mean you run into a cave and buy canned beans. It means you stop acting as if every serious portfolio should be composed entirely of assets whose valuation depends on central bank competence, fiscal restraint, and forever confidence in the reserve currency system. The source's gold discussion is powerful because it does not treat gold like a get-rich gimmick. It treats it like an acknowledgement that trust itself has become an asset you can no longer outsource casually. The fourth thing I would do is stress test everything against the wrong regime. Most people stress test against the recent past. I would stress test against the inconvenient future. What if long-term yields stay higher than the market wants? What if the Fed cannot save everything without hurting the currency? What if equity multiples compress? Not because the businesses became evil, but because the discount rate world changed and the market is still in denial. What if the dollar keeps reserve primacy but loses reserve innocence? What if the next 5 years reward discipline, optionality, and real assets more than passive concentration? That is the regime you need to face, because it is the regime most portfolios are not built for. The fifth thing I would do is separate early from wrong. The source says this clearly, and it matters because it is one of the cruelest lessons in investing. People who identify a structural problem before the crowd are often made to look foolish before they are made to look wise. That is not a contradiction. That is how markets work. A bubble, a distortion, a policy mismatch, a reserve drift. These things can all persist longer than pride can tolerate. Being early is painful. Being wrong is expensive. If your thesis is grounded in arithmetic and structure rather than vanity and timing theatrics, you can survive early. If your thesis is grounded in ego, you cannot. That is why humility is worth money. Now I want to bring this back to the bridge. A trust bridge does not collapse because one person notices a crack. It collapses because enough load arrives after enough maintenance has been skipped. The Fed's latest move, as the source frames it, matters because it suggests the institution is responding more to debt and political pressure than to pure economic discipline. The debt spiral matters because it narrows the room for honest choices. The long-end revolt matters because it tells you the sophisticated lenders are no longer offering unconditional trust. The TINA hangover matters because huge portions of the equity market are still priced as if the old cheap money environment can be reassembled on command. The reserve drift matters because the rest of the world is learning slowly not to treat us paper as costless neutrality forever. These are not separate stories. They are all load on the same bridge. That is why the source says, this time is genuinely different, not because no crisis ever rhymes. They do. But because the toolkit is more constrained, the fiscal backdrop is uglier, the geopolitical landscape is more hostile to a simple American financial solution, and the confidence assumptions underneath portfolios are far more fragile than people admit. That is a serious claim. It deserves a serious response. So here's the question I want you to answer, not publicly for me, but privately for yourself. Are you still invested like a person who believes the bridge is permanently self-healing? Are you still telling yourself that because the Fed always found a way, it always will? Are you still hiding inside concentration because it felt safe when rates were zero and there was no alternative? Are you still calling yourself diversified because the labels are different even though the dependency is the same? Are you still treating optionality like laziness and gold like superstition because that worldview was emotionally convenient in a more trusting era? Or are you willing to think like an owner now? Because owners do not wait for the bridge to fail before respecting the cracks. They reduce the load, they diversify the route, they hold some reserve, they stop paying any price for momentum, they stop confusing great businesses with great entry points. They start asking what survives a confidence problem, not just what thrives in a liquidity party. That is the contract with your future self I would write tonight. I will not let familiarity blind me to concentration. I will not let old policy habits trick me into trusting a new fiscal reality. I will not confuse being early with being wrong. I will not treat cash as cowardice if cash gives me optionality. I will not outsource all of my security to a bridge whose engineers are now taking political instructions. I will own some things that can survive the loss of monetary innocence. And I will remember that the market's most dangerous moments are usually the ones where the public still mistakes the warning light for good news. That is the test knot. Whether you can predict the day of the dislocation, whether you can read the cracks before the crowd hears the sound. Lone investor keeps dancing because the music is still playing. Another notices that the floorboards are flexing over a full cycle. The second investor is the one who gets to keep what he built. Be that person.